everyone, my name is Becky the Banana.
And I'm Oscar the Orange.
And we are here to tell you all about the difference between accruals and deferrals. First, we'll start off with the accrual method of accounting.
Wait, what is the accrual method of accounting?
Well, Oscar, the accrual method of accounting is when a company recognizes revenues and expenses in the period it is incurred or earned regardless of cash.
What do you mean regardless of cash?
By that I mean, you do not need cash to recognize if you have incurred an expense or earned revenue.
So if you don't have cash, then how do you account for accruals on the balance sheet?
Let's do an example so I can show you what to do more clearly. So in this example, Banana Incorporated experienced the following events in 2016, its first year of operations. In Event 1, it received $42,000 cash from the issue of common stock. This would increase cash by $42,000 and common stock by $42,000. It would be a $42,000 cash inflow from financing activities. In Event 2, Banana Incorporated performed $15,000 of services on account. This would increase accounts receivable by $15,000, which would be counted as revenue, and would increase net income, and when closed out would increase retained earnings by $15,000. In Event 3, Banana Inc. incurred $4,000 of operating expenses on account. This would increase accounts payable by $4,000. It would be a $4,000 operating expense. It would decrease net income by $4,000, and when closed out would decrease retained earnings by $4,000. In Event 4, Banana Inc. received $6,000 on account. So this would decrease accounts receivable by $6,000, increase cash by $6,000, and it would be a $6,000 cash inflow from operating activities. In Event 5, Banana Inc. recognized $2,000 of accrued salaries expense. So this would increase salaries payable by $2,000. It would be a $2,000 salary expense, which would decrease net income, and when closed out would decrease retained earnings by $2,000.
Wow, Becky, let me tell you, I sure am feeling very confident now in my understanding of accruals.
I'm glad, Oscar. Now, could you tell me what a deferral is?
Well, of course I can, Becky. Deferrals are very easy. You see, using the deferral method of accounting, companies recognize revenues and expenses after they receive or send out payment.
I'm not following, Oscar. Why would you record the event after payment has gone in or out?
Well, Becky, let me give you an example to help clarify. In this example, Orange Company experienced the following events in 2016, its first year of operations. In Event 1, on January 1st, Orange Company signed a one-year lease agreement and paid $15,000 in advance. The lease will begin on April 1st. This event will decrease the cash account by $15,000 and increase the prepaid rent account by $15,000. This will be a $15,000 outflow for operating activities. In Event 2, on the same day, Orange Company received $25,000 cash from Citrus Inc. for services to be performed over a one-year period beginning June 1st. This will increase the cash account $25,000 as well as increase the unearned revenue account $25,000. This will be a $25,000 inflow from operating activities. In the third event, on December 31st, Orange Co. made the appropriate adjustments. For the first adjustment, Orange Company must recognize that they have used 9 months' worth of their prepaid rent. To calculate this expense, Orange Company must take 9/12 of $15,000, or $11,250, and subtract it from prepaid rent and retained earnings. This is an $11,250 expense, and thus an $11,250 decrease in net income. For the second adjustment, Orange Company must recognize that they have performed 7 months' worth of their unearned revenue. To calculate this, Orange Company must take 7/12 of $25,000, or $14,583, and subtract it from the unearned revenue account and add it to retained earnings. This counts as a $14,583 worth of revenue, which will ultimately increase net income by $14,583.
I hope you have learned a lot about accruals and deferrals. From Becky the Banana
and Oscar the Orange.